Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Unifirst Corporation quarterly report. Unifirst Corporation offers a wide range of services to various industries across the United States, Europe, and Canada. The company's primary business involves providing workplace uniforms and protective workwear clothing, including shirts, pants, jackets, coveralls, lab coats, smocks, and aprons. In addition to uniform and garment services, Unifirst also provides specialized protective wear such as flame-resistant and high-visibility garments. The company offers first aid cabinet services and other safety supplies, as well as safety training services. This includes the rent and sale of non-garment items like industrial wiping products, floor mats, dry and wet mops, and textile products. Unifirst also engages in wholesale distribution and pill packaging operations for non-prescription medicines. The company provides garment service options, including full-service rental and lease programs. Furthermore, Unifirst offers restroom and cleaning supplies such as air fresheners, paper products, gloves, masks, hand soaps, and sanitizers. The company's services cater to various industries, including automobile service centers and dealers, delivery services, food and general merchandise retailers, manufacturers, maintenance facilities, restaurants and food-related businesses, business service companies, soft and durable goods wholesalers, transportation companies, energy-producing operations, and healthcare providers. Unifirst Corporation market capitalization of $5 billion is significantly larger than the average industry peer of roughly $0 billion. This shows that Unifirst Corporation holds a significant advantage in their industry. Unifirst Corporation trades at a higher price-to-earnings ratio of 34 times and a higher price-to-book ratio of 2.11 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The balance sheet appears very conservative, with liabilities representing only 22% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The company comfortably covers its interest expenses through operating income and maintains a strong cash position relative to current liabilities. Additionally, special charges appear non-recurring, suggesting high earnings quality and strong financial resilience. The primary drivers of revenue growth or decline can be identified through an analysis of the extracted summaries. Revenue growth is primarily driven by uniform and facility service solutions, which experienced a significant increase in revenue of plus 105.5% over the 26 weeks ended February 28, 2026. Additionally, first aid and safety solutions saw a notable growth of plus 12.2% due to double-digit growth in the van business. On the other hand, revenue decline is primarily attributed to first aid and safety solutions, which experienced a decline of minus 4.2% over the 13 weeks ended February 28, 2026. The other segment also saw a decline of minus 1.9% over the same period due to the wind-down of a large refurbishment project and lower reactor outages. Other factors that affected revenue include an inflationary environment, increased energy costs, higher wages in labor markets, elevated interest rates, geopolitical issues, and tariffs on imported goods. These external factors had a negative impact on margins, contributing to the overall revenue growth or decline. The net income of the company experienced a significant decline over 2 different periods. In one instance, it decreased by $12.7 million from $67.6 million to $54.8 million. However, in another period, the decrease was more substantial at $15.4 million, representing an astonishing 17,800% drop from $86.7 million to $71.3 million. The profit margins of the company also underwent a decline. The operating income margin decreased from 5.1% to 4.2% over 13 weeks, and from 7.2% to 5.7% over 26 weeks. Similarly, the net income margin dropped from 4% to 3.3% in 13 weeks, and from 5.6% to 4.4% in 26 weeks. The reasons behind these changes are attributed to lower cash flows from operating activities and unfavorable adjustments in various accounts such as rental merchandise, accrued liabilities, prepaid and accrued income taxes, and overall profitability. These factors collectively contributed to the decline in net income and profit margins. The company is indeed generating positive operating cash flow. This is evident from the financial data provided in the summary. On page 13, it is stated that the company generated a positive operating cash flow of $88,475 for the year 2026. Furthermore, on page 32, the company's total operating cash flow is reported to be a significant $88,500,000, which is also a positive figure. Additionally, the data from page 15 shows that the company has consistently generated positive operating cash flows over different periods of time. Specifically for the 26 weeks ended February 28, 2026, the company's operating cash flow was $123,490,000, and for the 13 weeks ended February 28, 2026, it was $107,219,000. These figures collectively indicate that the company is generating a substantial amount of positive operating cash flow, which is a key indicator of its financial health. The company's debt level has experienced a slight increase over the past year. From 2025 to 2026, the debt rose by approximately $7,908, reaching a total of $617,106. This modest growth suggests that the company is taking on more financial obligations. However, despite this increase in debt, there are no significant changes in interest expenses. The data does not indicate any substantial fluctuations or spikes in interest payments, suggesting that the company's financial situation remains relatively stable. The company's performance can be analyzed through its various segments and regions. Two segments stood out as performing well. The Uniform and Facility Service Solutions segment saw a significant improvement in net loss, with an increase in operating income in both periods. This was accompanied by revenue growth of 3.2% and 2.8%. Another strong performer was the First Aid and Safety Solutions segment, which experienced a substantial revenue increase of 12.2% and 13.7%. On the other hand, the other segment struggled to keep pace with its peers. The segment's operating income decreased in both periods, indicating a decline in profitability. Furthermore, the segment saw a decrease in revenue of 1.9% and a decline of -2.4%. These numbers suggest that the other segment is lagging behind the company's other segments. Management is cautiously optimistic about the company's outlook despite potential economic headwinds. They acknowledge that sustained inflation could pressure margins, but moderate changes in the inflation rate are not expected to significantly impact results. To mitigate risks, management is investing in digital transformation and building capabilities to drive growth. Key initiatives include completing an ERP project by 2027, which will enable cost savings and efficiency improvements. Additionally, management is focusing on customer retention through investments in service staffing and addressing healthcare claims expenses. Financial projections indicate that the company has sufficient liquidity to meet working capital and capital expenditure requirements for at least the next 12 months. Management's strategy emphasizes investing in growth drivers while managing inflation-related risks. By executing these initiatives, they aim to drive continued improvement in customer retention and ultimately accelerate growth. The company has a history of returning value to its shareholders through both dividend payments and share buybacks. On the dividend front, specific amounts have been recorded for the years 2025 and 2026, totaling $12,153,000 and $12,470,000 respectively. In addition to paying dividends, the company has also engaged in share buybacks, with notable transactions taking place in 2025 and 2026. The company spent $12,528,000 on buying back shares in 2025, and a significantly larger amount of $32,600,000 $736,000 in 2026. There are concerns about inventory buildup and supply chain disruption that may impact the company's operations. Disruptions in Mexico and Nicaragua could affect the availability of raw materials, while tariffs on imported goods may increase costs or make it difficult to obtain necessary products from suppliers. The company's CRM system has a material weakness that affects revenue, receivables, and supply inventory. This issue is likely to exacerbate concerns about inventory buildup and supply chain disruption, as accurate tracking and management of inventory levels are crucial for maintaining a smooth supply chain. That concludes the financial summary for Unifirst Corporation. Feel free to comment below, and I will be happy to answer them when possible.